Hi everybody, I'm Leanne Horton, the Country Club President. I will tell you that I have had the benefit of only being president this whole time. It's only going to be 10 months because John Jennings was president, as you know, when the pandemic hit. And he was amazing and took us through another 2 months, and I started in June. But we're here and it's strange. But you guys are probably used to being on Zoom or seeing things virtually. We have had 3 meetings. We met with the past presidents, and then we met with committee chairs, and then finally we had a town hall a few weeks ago, and it was awesome. We probably got to talk to about 50%, but we thought it was so important that every single one of you be able to hear this presentation. So we decided to do this virtually so you could see it. So I want to give you a little background on where we've come. March 17th, as the world knows, the pandemic hit. The board did not know what would happen, and so we met weekly, and I think you know this, we've told you this, because we were worried that the financial stability of the club was going to be called to question. And thankfully, we have come out ahead. One of the things we've tried to make a priority is communicating. And so we have had bi-monthly, lengthy emails from Eric and myself just telling you where we are. As you know, we're ahead of budget, but we have had things that we've had to cut out from the club. And so that's one of the reasons that we are ahead of budget. But we're slowly trying to get those things back. We've increased the fitness club hours. Starting this weekend, we'll have a Sunday night dinner. So we are trying, but bear with us. Eric and his staff are doing a tremendous job, and we could not have done it without them. So I want to take a minute to tell you why we're even meeting tonight. We're going to talk tonight about capital. So your normal dues go for operating. We are not talking about the operating business of the club tonight. It's all about capital. And so what is capital? Capital is about 3 different buckets. It's mainly deferred maintenance, debt, and any new projects. So debt and deferred maintenance are what you'll hear Tom refer to as obligatory capital. And then new projects are aspirational capital. So we had an incredible committee that has worked diligently. We hired a company called Club Benchmarking, and Brian Joseph, Kevin Taylor, John Jennings, Bill Moss, Tom Cinema, who you'll meet in a minute, and of course Eric, Brenda, and Charlie and I met 8-9 weeks in a row. They were tremendous. We hired them because they're the experts around the country in helping clubs figure out this piece of their club. So you're going to hear a lot of numbers thrown at you tonight, but just pay attention because this is your club. And so one of the main things I want to ask you is, do you rent your house or do you own it? So when we asked everybody before, I don't think we had anybody that owned it. You might own a rental property, but you probably own, or maybe the bank owns your house. So one of the questions that Club Benchmarking posed to us was, do you treat the Country Club of Orlando like you're a renter of the club or you're an owner of the club? And I don't know about you, but it was pretty convicting for me because I think that I have maybe thought, oh, somebody else will do that. Somewhere down the line, they'll fix that road, they'll fix whatever. But we need to think of this club as owners. We are owners. If you own stock of this club, you do own a piece of it. And if you're going to leave that stock to your future children or grandchildren, we need to take care of it. So I really want you to think about that as Tom presents. So normally Bill Moss would come up and talk about membership, but he decided he couldn't make it tonight. So I'm going to give you just a quick overview. Since September of 2019, as you know, we had all these category changes. We introduced a trial membership, an out-of-town membership, a social membership, and we've had tremendous success. Brenda Clayton and Heather Taylor have been amazing. I know you get the bulletins of all these new members. There have been 81 new members since September to this year, which is unbelievable. However, the problem is we've had 41 leave. Now that could be because of financial situation, it could be because they passed away, it could be because they moved away, but net, that's still only 40 positive, which is actually tremendous compared to our our past years, which you'll see from a slide from Tom. But I just want to say that every member is important. And if you haven't, Bill did this earlier, if you haven't sponsored a member, you need to. Again, are you an owner of this club? Do you want this club to succeed in the future? Please help us bring in new members. It's so easy now. You call Brenda or Heather and they'll take it from there. So without further ado, I'm going to turn this over to Tom Senna, my good friend, to give you the more information for tonight. Thanks so much.
Thank you, Leanne. I'm Tom Sittema, and I wished I had the opportunity to be presenting in front of all of you. And those of you that I don't know, I'd love the opportunity to become acquainted with you. Our purpose tonight is really to share, as Leanne mentioned, a lot of work that we've done as a committee and a board on some strategic planning recommendations based on lots of work, particularly from Club Benchmarking. Club Benchmarking was the firm Leanne referenced that we engaged. Club Benchmarking did not just build a financial model for us. What they did, in addition to helping us build a financial model, they analyzed every specific asset that we had, whether it's a roof or whether it's a chiller or whether it's a refrigerator, or whether it's the sprinkler system on the golf course, and they made an estimate of what all that would cost. And so this first slide sort of summarizes kind of the scope of their work. And as you're referring to the slide as I'm speaking, there's really a number of items. First is identifying all the capital needs. As I mentioned, they analyzed every single asset in our club, estimated the useful remaining life of the asset, and put together a replacement schedule of what it would cost both to maintain as well as to replace over time. So those are the capital needs for the club. Secondly, what are the capital sources? What are the revenues? As has been mentioned by Leanne, we're not focused on the operations, sort of the covering of the salaries and benefits of the employees and sort of the tennis and golf and so forth. We're focusing on the capital needs. And as a member, you have your monthly dues, but you also pay $160 a month for capital dues. That's what we're referring to here. Additionally, new members pay the initiation fees either up front or over time. Those are additional sources of capital sources. Thirdly, what are the gaps that come out of doing those first two? Fourthly, what are the funding strategies to plug those gaps? And lastly, what are sensitivities that we're focusing on? That's the scope of the work. All right, so importantly, let's get the nomenclature right. So we want to focus on two types of capital needs. One is obligatory, the other is aspirational. As you're referring to the slide, obligatory capital needs are those needs that just require normal replacement reserves. It certainly would encompass deferred maintenance, and it's basically keeping the assets that we already have in tip-top condition so that we can deliver the membership experience that you and we have all come to expect. The ideal source of capital for those is the monthly capital dues. The second type of capital need is aspirational. Aspirational would be sort of the major improvements that we would make to a club. For instance, if we want to make a major investment to improve our fitness facility or our poolside dining experience or doing a pool renovation or add some new amenities like pickleball or what have you, those would be aspirational. The club has spent probably $10 million in the last 10 years on aspirational types of investments. And in fact, the industry standards is about $5 million every 5 years. So call it $1 million a year, plus or minus. And if we don't budget that, then we're sort of kidding ourselves, because that's what the aspirational types of needs are for us to maintain a club experience that's competitive with competitive clubs and that our members come to expect. So aspirational and obligatory, and I'll refer to that throughout this presentation. Three main takeaways from Club Benchmarking, as you can see on the slide. The first is we have a significant amount of deferred maintenance that has sort of built up. And I'll show you some slides in a minute of what that looks like. Much of the deferred maintenance is not even apparent to your eye because it's sort of back of the house, if you will. But nevertheless, it's deferred maintenance that is essential for us to get ahead of, and we've sort of fallen behind. The reason we've fallen behind is for the second takeaway is we have significant levels of debt, substantially more debt, frankly, and this is in my opinion and that of the board, more debt than really what a club like ours should have on a sustainable, durable basis over time. A lot of questions in the town hall about that debt. I have slides on that. We have about $7 million in debt today, and we probably should have roughly half of that, or maybe $4 million on a sustainable basis. And so because we have excess debt service, and we spend over $1 million a year just servicing the principal and interest of our debt. And the third key takeaway is the club would benefit from a more proactive and strategic type of financing plan, strategic financing funding plan, so that it's more of a proactive than a reactive funding. I've had a number of members say to me, why do we get these small, assessment here, assessment there, increase here, increase there, as opposed to more of a strategic plan? The other benefit, candidly, of a strategic plan is if we have a funding plan over 10 years, which can be updated on an annual basis, then as the board transitions and changes each year, the new board members and the new board chair will have the plan to work with, as opposed to sort of developing their own plan each and every year, which is not as consistent. It's helpful for us to have just a bit of a historical perspective of how did we get to the debt level that we are, how did we get to the deferred maintenance that we are. And the point here has nothing to do with sort of being critical or casting blame, because the fact is we've made some very significant and critically important investments into the club at critical times, and this slide will show we've spent significant dollars renovating the golf course. Quite honestly, just as a personal testimony, I wouldn't be here as a club member had that golf course renovation not been done, because the course was falling significantly behind its peers. That was critically important. We've invested in a maintenance facility that we actually had no choice to. We had pressure to do that for safety and so forth. We have tremendous ballroom facilities. We have significant, but for COVID, we have significant ballroom activities and weddings and that sort of thing, which obviously we need to continue to maintain. And lastly, we had to invest in a cart barn facility. So that's almost $10 million that we've invested, and some of that was coming out of the great financial crisis and so forth. So it took significant courage for the prior boards to commit to those types of enhancements and aspirational improvements to the club. And quite honestly, we as members today benefit from the quality of the assets that we have, in large part because of those courageous decisions in the past. However, the financing that was chosen for much of those was debt. And as you can see in this slide, and there's a lot of data on this slide, and I'll try to decipher it as you're looking at it. There's two different measurements on this slide. The bar at the very top shows the number of members. Well, all the way back in 2006, we actually had 920 members, and it dropped fairly precipitously coming out of the great financial crisis in 08 and 09 and following. And only in the last couple of quarters have you seen it start to climb. So we were down to 670. We're now currently, as of today, 702 members. Leanne mentioned the significant progress we've had with new members, and want to encourage all of us to have a responsibility to source and secure and recommend and refer new members. And by virtue of that, we've added on a net basis 40 new members. We've added new membership categories, and we're having some significant success. And there's no reason that we shouldn't assume that that could continue, particularly as we continue to invest in the club. The other information shown on this chart is the bars with the numbers in yellow. Back in 06, we had about $4 million in debt, $3.9 million to be exact. When some of those significant investments were made back in 15, 16, and 17, particularly the golf course renovation, much of that was financed with leverage, which, as you can see, our debt climbed to almost $9 million in 17, over $9.5 million in 18, and it's now down to about $7 million. So we're making some headway in paying it down, but by virtue of this extent of leverage, we're paying interest and principal on these facilities, and it eats up $1 million a year, actually just a little bit over that in debt service. So when you look at all that, and based on the work of Club Benchmarking estimates that to get on top of our obligatory capital needs, all the deferred maintenance, the ongoing repairs and maintenance, as well as some of those significant items that sort of catch you by surprise. You know, when the HVAC would blow out, or when the sprinklers need to be replaced in a golf course, and it's a multiple $1 million item, you have to have plans for that. You add all that together, and over a 10-year forecast, it's about $1,750,000 a year is what they recommend our club set aside and plan to spend for obligatory needs. Now, to be clear, that doesn't mean we replace something that doesn't need replacing, but it is a budget that you work with, and if it is broken, you replace it. If it's working fine, you don't, but you have the dollars in the budget so that you're not in a reactive type of a mode. Debt service here is over $1 million a year. And yet in the capital dues item of $160 a month, which is the source of funding for those two items, is $1,200,000 a year. So it's pretty clear we have a meaningful shortfall of $1,650,000 a year on a run rate basis. And obviously you don't make that up in volume. When you're running with that kind of deficit, something has to give. Debt service is not going to be what is given. So you end up having to sacrifice in terms of the repairs and maintenance. I want to show you just a few slides of some of the deferred maintenance items. And you would see some of this, but generally the staff has done really a remarkable job, sort of putting lipstick in certain places and keeping this away from sort of our membership experience. But you can see some of these slides, particularly in the kitchen, the refrigeration, the HVAC system, the chillers. Some of these items frankly are way beyond their useful life. And if we have one of these go down and we haven't budgeted for it, and you write a check for $250,000 or $500,000 for some of these items, that would put a hurt on anybody. It certainly would put a hurt on our club, our collective club, and we just need to do a better job of that. If we had the resources to invest in our obligatory capital needs for deferred maintenance, this is a list of some of the things that we would spend money on. So initially, Club Benchmarking actually had recommended you probably ought to spend as much as $3 million in the first 12 or 18 months. We obviously, to do that, you'd have to have the club closed half the time, and so we wouldn't do that. But this is a list of some of the things that we feel like are essential for the club to continue to invest in. The point here is not to have a debate about why are we spending $26,000 on tennis or what have you. It's really to highlight this is a list of things. It would get fully vetted to the extent we had the resources to do it. But the point is, there are significant needs. We'll go through a disciplined process of deploying the capital to address the needs that are most critical, and we will be absolutely prudent and appropriately conservative in deploying the capital to fix what needs to be fixed and maintained. The aspirational capital items, I said, was the second major item. Those are sort of the big ticket items, as the name implies, the aspirational, sort of the dreaming big. We've just simply slotted $9 million over the next 10 years, 4 of which is earmarked for a poolside renovation. So we don't have a budget specifically for that, so quite honestly, it's a plug figure. Our estimates were $3 to $5 million. We plugged $4 million, and then we allocated another $5 million down the road towards year 9 and 10 of a 10-year forecast. We don't have an item of what that would be, but history and best practices across clubs across the country would suggest that we will absolutely be spending that, so we may as well budget it. If we don't need it, we don't need it, but it's more likely than not that we will. So I'm displaying a picture of sort of a poolside renovation. It will not look necessarily like this. This was some work that John Jennings and a team had done just to highlight some ideas, but it's simply to allow you to visualize what could be. It's sort of picture the possibility. When we talk about a pool renovation, one of the questions that we had, we're not talking about necessarily renovating the pool, although there will be some work done on the pool, but we're really more talking about the poolside experience, the dining, the grill, outside dining, some television activities and that sort of thing. I referenced, I used to be a member of Interlock, and I would encourage any of you to go and see what Interlochen has done to their pool and their poolside experience. It's literally unbelievable. We don't have to do something where you've got, splash pads and sort of a mini Disney kind of experience in our pool, but their dining experience is really pretty special, and there's no reason why they would have a lock on that in our community, and we can't do something that's similar, if not better. When they did that, by the way, as an aside, they had a pretty sizable assessment to the membership. There was some controversy over it. They had feared that they were going to lose a number of the members. They actually not only didn't lose, they actually gained members. And today, Interlochen has a freeze on new members for golf, for juniors, for social, and I think for tennis. They're literally at capacity, and in part because of the renovation that they did in their poolside experience. So when you look at all the obligatory and all the aspirational, based on a financial forecast inclusive of our debt and our debt service over a 10-year period, we've taken all of those numbers, and it's a significant financial model, as you would expect, and we've tried to summarize it on one page, which will probably just make some detailed analytical people crazy, and others maybe it's too detailed. But what we try to demonstrate here is on a 10-year basis, obligatory $1,750,000 a year times 10, $17.5 million. The aspirational I mentioned was $4 million for the poolside renovation, another $5 million plugged down the road. Debt service on an annual basis will cost us about $8 million over 10 years. The funding sources that are already in place today identified, which is the $160 a month in capital dues, plus the initiation fees from new members, both past that are paying it over time as well as from this point forward. And our forecast, as Leanne mentioned, shows about 10 new members on a net basis per year. So 10 full membership equivalent new members per year on a net basis. When you add up those sources over 10 years, it's about 23 million. We have in here a additional source for lot sales. We've talked to the membership in the past about the excess land along the fairway on number 8. We have now done significant work Vic Farina and Harlan Hansen and others have been with the city a number of times. We believe we have sort of the approvals that we need in order to allow a cul-de-sac to be cut there and have 3 lots that could be platted and sold. The club could not cut the street in and put the utilities and sell individual lots. That's incongruent with our nonprofit tax status, but we could sell them to a developer or a builder to do it. We are of the mind as a board that that is land that is unnecessary and it's an idle asset and could be deployed to generate proceeds to avoid an assessment. And consequently, we are suggesting here that the club would consider those lots to be sold, generating about $1.25 million of additional proceeds. We're not asking for that vote today. We're going to talk about that when we take the vote on all of this, but we want you to be thinking about that. And when you add all that up, we have a funding gap over 10 years of $10 million. It is obviously very, very significant. And doing nothing in our option, or in our view, is not an option. So we have to do something. And part of we have to have a strategic plan to address that shortfall and to address the significant amount of debt that we continue to service. The next slide summarizes a little bit more in detail on the debt. As I mentioned, we have $7 million in debt. We have 4 different debt facilities. This, again, is more detail than some of you want and maybe not enough than others. We have around a $400,000 facility that matures in 2 or 3 years. We have a $600,000 facility that matures in 3.5 years. And then we have a $2 million and a $4 million facility that are about 11-year full amortizing loans. You add that up, it's about $7 million. A good portion of that debt is hedged for interest rate protection that was put in place some time ago. So to prepay it would be quite punitive given today's interest rates. So we could pay down about $1.5 million, $1.8 million of the debt today if we had the resources to do it. The balance would just be amortizing over time. I will say from a best practices standpoint, when you look at what kind of leverage should the club have, we should have about 1/3 of our total revenues in debt. And as you can see in this slide, our total, the industry median is 32%, so call it 1/3. We have about $10.5 million in revenues. That would yield about $3.5 million in debt. We're at $7 million debt today. I don't have to tell any of you the burden of having excess debt on a business, on a home, on a rental property, or on a club is dangerous over time. And clearly debt, excess debt, is the #1 killer of country clubs across the country. So it is an issue that we have to address. The good news is it's not that complicated to address. We're not so out of control, but when you add it up with some of the other challenges, it requires some action. So we have an enormous opportunity today in somewhat of an inflection point to put the club on a very, very stable and secure path for the next decade or so. The next slide summarizes sort of our guiding principles as we, as a board and a committee, worked to develop a plan to recommend to membership. We first started with what are the guiding principles that we want to be governed by as we put this plan together. We mentioned operations. We're not talking so much about operations tonight, but one of our guiding principles is we want to run the club at break even at a level of membership experience that we all have come to expect. So our dues will change on a year-to-year basis for the sole purpose of running the club at a break even. That is a first guiding principle. Secondly, We want to have our capital dues sufficient to fund the obligatory capital needs that we have. Those need to be adjusted so that we're not running with significant deferred maintenance and sort of always trying to play catch up on our assets. Thirdly, the initiation fees for new members ideally should be earmarked for aspirational needs. That's kind of the ideal source of funding for aspirational needs, would be new member experience. And lastly, our debt should be run at a level that is much more sustainable over time. And that level is probably in the $3 to $4-ish million based on our numbers today. That changes as we add more members or what have you, but we want to manage our leverage at a place that is a comfortable, moderate, if not conservative level of financial leverage. Those are the guiding principles that will govern and have governed our recommendations to you for your consideration of a sort of a strategic capital funding plan. Before I get to those recommendations, I want to go over one other critical piece of information for context. It's always important for us to know where the club stands with respect to its costs, with respect to its membership dues, monthly dues, capital dues, and so forth. This slide identifies our key competitors, and it works left to right from the least expensive to the most expensive. Bay Hill is the least expensive by a little bit over our club. Some members would argue it's probably not a great benchmark for a competitive club, principally because it's a semi-private club. It has an annual tournament that funds a significant amount of its costs. So it's not ideal for a direct comparison. The next least expensive club listed is the Country Club of Orlando, and you can see the numbers in terms of what we spend to date. And on this slide, this is all of your monthly costs, including the $60 operational membership dues increase that was passed last year on a temporary basis until we had this overall plan and to reassess that. It also includes the $160 capital dues that we all pay on a monthly basis. And you can see the category of initiation fees and so forth. Importantly, Interlochen, which often is mentioned as the biggest and most direct competitor, is literally 25% more expensive on a monthly and an annual basis than we are. 25% more expensive. And by the way, as I mentioned earlier, they are closed to new members because they're at capacity in golf, in social, and in junior. But nevertheless, they're still 25% more expensive. So let's keep that in mind as we talk about the membership experience and as we talk about the need to make some of these improvements into our club. Now, drum roll, we're going to what the recommendations are. And we've kicked around two different options for your consideration. And we presented this to the town hall, and we've started to get a number of ideas and feedback from the membership, and we want to hear from you as well. So track me down, track Leanne down, track the board down, track the finance committee, track the staff down if you have ideas or questions on this. The two options that we list here, option one, option two, the first one is essentially an assessment of $5,000 in option one for members. I'm going to show a chart in a minute to see how that is allocated, prorated across the membership categories. But it's $5,000 per full-time membership equivalent. For those of you, if we elect that option, for those of you that would like to have some of that financed and amortized over time, we would create a financing program for half of that over 18 months. So $2,500 up front, $2,500 spread over 18 months. Secondly, in option one, we're talking about an increase in our capital dues, those monthly costs that we all experience that today totals $160. We're moving that to $200 a month in option one, and there will be some additional increases of that over time to keep up with inflation. We think roughly about $10 or so on an annual basis thereafter. But that would move us to $200 initially and allow us to make a meaningful dent in the obligatory capital needs that I've already identified. And thirdly, the takeaway from an assessment as well as that capital monthly increase would allow us to invest in a poolside renovation probably 2 to 3 years from now. We would have enough capital resources in order to make that significant investment that we have heard from so many members is a priority for us. We would be able in option one to do that in sort of 2 to 3 years. Option two has some of the same characteristics. The biggest difference is the assessment is $8,500, so it's a larger upfront assessment. The capital dues increase is lower. It's not $40 a month, it's $10 a month. But by upfronting, front-end loading, if you will, the upfront assessment, it allows us to do the poolside renovation probably a year or so earlier in that scenario. I would say one of the biggest takeaways we've heard from the town hall that we've had live and some of the previous presentations is there is I'd say a burden on many members, frankly, including many of us on the board, if not all of us on the board, to try to accelerate the investment in that poolside experience as soon as we can. And the board and the committee are already working on ways to try to figure out how we could do that sooner, even if it's deferring some of the needed obligatory improvements and slide that a little bit in order to move that major investment up. The next slide just summarizes the assessment for option one, the $5,000. Here's how it would break down per member based on sort of your membership category. And this is fairly consistent with how the club has done these types of things in the past, based on sort of prorations across the membership experience. I'd say importantly, and if you're a new member or a trial member, we are not assessing new members or trial members any of this expense other than the monthly capital dues increase. The monthly capital dues increase, if these options are passed, would impact all members equally. The upfront assessment is not to be a burden of new members and certainly not of trial members, and it is prorated here according to your membership category. I want to show what we will do with the capital, because it would be inappropriate for us to have an assessment and have monthly capital dues increase without in part addressing the debt. I mentioned we have $7 million in debt. By virtue of either option one or option two, we would reduce that debt by about $1.7 million with these proceeds. That's why we want to have a good bit of it paid up front so that we could deleverage. If we reduced our leverage from $7 million to about $5.3 million, which is the maximum amount we could pay down without incurring penalties for our hedges and so forth, that would save about $400,000 a year that would be freed up to be able to invest in the capital needs of the club. And also with the amortization schedule in place, in about 2 to 3 years, our amortization would reduce that balance closer to the $4 million area, which is kind of a target that would be a healthy level of debt. So as part of this assessment, we would in part fix our balance sheet and we would be able to catch up on deferred maintenance, and we would be able to build up cash reserves over time to make these aspirational types of improvements. We clearly could have recommended a much higher assessment and made a bigger dent on debt and made a bigger sort of impact and done the pool sooner and so forth. This is more of a measured type of an approach, more consistent, we think, with what the club would experience, and certainly that was evidenced by the feedback from the first town hall. So you can see the amortization schedule here. The last slide I want to show you is kind of what happens if we do option 1, what happens if we do option 2, and what happens if we don't do anything. The red line is a quite scary future for the club, and frankly, it's unacceptable to me personally. It should be unacceptable to all of us as members, and it is perilous for the club to be in that kind of a financial picture. The good news is it's not that difficult to fix, and I do not make that statement lightly as if an assessment is easy for all of us, because it's not. But nevertheless, we're not talking about $10,000 or $20,000 here. We're talking about $5,000 to $8,500. We'd love your feedback on which of those options that you prefer. In the original town hall, it was virtually unanimous to support either option 1 or option 2, and it was about half and half of the feedback that we received. And again, the biggest difference between the two options is option 2 is a little bit larger assessment that accelerates the ability for us to do the poolside renovation, and but over time it's roughly a similar amount of capital raised. So that's the sum total of the presentation. I think we addressed a number of the questions that came up in the audience as I spoke and as Leanne spoke. Leanne, are there any other questions that we should address?
The only thing that we heard from the town hall was, are you guys right? Like, do you think this is perfect?
So yeah, I made a statement at town hall that I guarantee one thing in this plan, and that is we'll be wrong, because any 10-year forecast is going to be wrong, because you have like pandemics, or you have other great recessions, or you have competition does certain things that you have to react to, or what have you. Having said that, that is not a reason not to plan. You just have to have a discipline to plan, and then on an annual basis to update that plan. But what this does do is it doesn't guarantee our future in any way. It does increase dramatically the probability of success. It does increase our comfort level and sort of the sustainability, and it also candidly helps ensure the membership experience is what we've all come to expect. We don't need, I made a comment which was offensive to some, we don't need a Four Seasons experience, and somebody says, wait a minute, I feel like we have a Four Seasons, or we should expect it. We don't really need to have a Four Seasons kind of experience, but we certainly don't want a Motel 6 experience either. And this is a level of a membership experience that we should expect. I personally believe that we have a unique opportunity to do this, and now is the time for us to do it. It's a real advantage for us that Interlochen is closed to new members. We've already secured a number of members that might have gone to Interlochen, but for the fact that they're not able to go there now, so we've been able to secure them. I talked to one 2 weeks ago, and he's thrilled with his choice to have joined CCO. We have an opportunity to do that, but there's no reason why we can't have the best facilities, the best experience. We already have the best membership. We have great assets. This is our time. This is a time that we need to sort of, seize the moment and help secure the stability and the ability for our club to invest in its future in a prudent and appropriate manner.
Only two other questions that we heard before. Did you guys consider any losing of members in your plan?
Great question. Every time you have an assessment, you should assume you're going to lose some members. So we have dialed into the forecast that we would lose about 20 members in option 1 and 30 members in option 2. And those are full-time equivalent members. So it could be more members than that in total, but full-time equivalent dues-paying members. And as I've already mentioned, our financial forecast shows that we're adding, after that initial loss, 10 new members net on an annual basis. Who knows if we're going to do that on a consistent basis. We certainly think we can do that, should be able to do that, should be able to do better than that, but that's our forecast. And as Leanne already mentioned, in the last year, by virtue of a lot of hard work of a lot of people, we're net up about 40 new members. We're not projecting to continue that, but we certainly can build momentum, and this could be the club and should be the club that everybody who comes to town should want to be a member.
Okay, I lied. Two more. How expensive will we be compared to Interlochen after the capital dues increase?
So when if option one is passed and we go from $160 to $200 a month, we will still be 20% cheaper on a monthly and an annual basis than Interlochen. 20% cheaper. That is meaningful.
Awesome. And then the last question is, are you telling me we can do all this, these projects, the pool, and we're not going to incur more debt? We're going to do these projects without debt?
Yes, I think very confidently what we're saying here is if we pass one of these two options, in either case, we will make a meaningful downstroke on our debt. We will move it from $7 million to $5.3 million, and we do not forecast borrowing in the 10-year forecast any additional amounts of debt. Rather, we show with the scheduled amortization that debt being reduced about $500,000 a year. Having said that, if we're in the financial picture that is stable and we're a couple of years in and we're seeing the membership count grow and all that sort of thing, when you get your debt down, you have the liberty to do different things, and it gives you the financial freedom and flexibility to make those types of prudent decisions. But the base case of our plan is we reduce our debt consistently throughout this time period, and we do not add additional leverage. We would, first of all, for you to take this much time, if you're still listening, that is a commitment on your part, and for that we are very, very appreciative and grateful. Seriously, go through it. You've got the benefit of the slides that you've seen. Track us down, give us your feedback. The feedback in the town hall, as I already mentioned, and from the prior experiences, is overwhelmingly in favor of the lot sales, in favor also of either option one or option two. We don't expect to have unanimous vote on this, although it sure would be special, and it would really be affirming to all of us that have worked on it. Having said that, we do expect something like this to be an overwhelming majority for us to do this, but we would love your feedback. So thank you.